Tobi here from Track Capital. I'm here today bringing you the latest UK house price index report from HomeTrack. So this report covers the month of August 2021 and has been published today, 28th of September 2021. So what we're going to do is look through the main headline figures and then move on to the summary. Just in case you haven't got a lot of time to watch the whole video, just feel free to watch just this part. And then after this, I will then go on through the whole report in more detail. So if you do have time, please feel free to stay tuned and catch the rest of that. So let's get started with the first main headline figure. So we're going to look at this one here. So this is the current UK house price growth, which is currently running at plus 6.1%. So that is showing average house price growth here in the UK as going up by 6.1%. This is slightly higher than the previous month, which I believe was sitting around 6%. So only slightly up, marginally there. Then we have the next figure here, which is actually the demand for properties. And this is year-to-date figure versus 2020. So demand is up 19%. So a slight slowdown when comparing it to the last report, which covered July 2021. That one had an increase of 21%. So demand has cooled ever so slightly. However, the next figure we go on to is the flow of new supply. And year to date, that is actually down 5%. So these two figures here, when put together, are one of the main driving factors behind why prices are increasing rapidly and why actually we don't see this changing anytime soon. Now, the flow of new supply is actually down from the previous report, which was minus 3%. So we are seeing supply decreasing. Although demand has cooled slightly, it is still very, very strong. And obviously supply is going down as well. So even with the slight decrease in demand, because supply is decreasing, we are still getting this strong house price growth. Now on to the summary. So what you can see here is HomeTrack have outlined that there isn't a sign of a sudden drop-off in demand, which some people had predicted or insinuated may happen after the ending of the tapered stamp duty. Remember, it was the end of June that the original stamp duty holiday ended, and then we had the second phased part, which is going to be ending at the end of September. So what this report is showing is that demand hasn't just dropped off because the stamp duty holiday is coming to a complete end, which is, again, very positive to see. I had been saying quite a lot that I didn't actually believe the stamp duty holiday ending at the end of September would have a massive effect, and according to this report, it's looking at a similar point of view. So as we know, demand remains very high, and it's actually higher than typical for this time of year, and that's amid low levels of supply. So this imbalance, as I mentioned, is continuing to put upward pressure on house prices. And they are anticipating that this will start to unwind later in the year, which, again, tends to naturally happen when we move into sort of the later autumn and beginning of winter months. We start to see demand naturally taper off in the property market anyway. That said, we sometimes see that in the summer months as well, and we didn't see it as strongly as I'd actually thought may happen. So I'm still a bit dubious, 50-50 whether demand will cool as much as some people are anticipating. I've got a feeling it might still stay strong, and mainly down to the fact that supply is very, very low. So you're still going to have lots of people clamoring over the properties. People are still searching for space, etc., etc. So there's a lot going on in the market, especially people wanting to capitalise on the low mortgage rates, etc., etc. There's a lot of factors there as to why I think it will continue. Now, the market continues to move quickly in the sense that properties are selling very, very quickly. So as you can see here, to sell a property is averaging less than 30 days, and that's since May. That's incredible, an average for a property to sell. Buyer demand is actually picking up in London, they've noted here. That's with a 14% rise in demand over the last month. So probably down to the fact that offices are open back up. People are getting back out there to work. Obviously, travel is opening up a lot more. So, yeah, you can see why we are starting to see demand pick back up in London. Not surprising. And again, London is something that we've definitely spoke about here at Track Capital as will come back and do very well and bounce back because it's London. It's always been a strong property market, and once normality becomes more prominent, that I think London will definitely do a lot better and bounce back. So just looking at these figures here, you've got demand obviously up here, number of sales agreed, and you may not know, sales agreed is where a property has been agreed to be sold. So that's basically where a seller and a buyer agree on the purchase and sale. So it doesn't mean the property has completed, and it does mean that it could still fall through. It just means that they've agreed that sale there, hence the name. And obviously we can see here flow of new supply down and stock of homes for sale down quite a lot. So yeah, these sort of vast differences are the reason we're experiencing this strong capital growth, and have been experiencing it for quite some time since the pandemic. You'll see a note here from the head of research at Zoopla that demand from buyers searching for space, making the lifestyle changes, etc. after the lockdowns and being trapped inside, that's got a further lifespan to run. So they see this carrying on. It's not just going to stop because normality is coming. People have had a sort of change of mindset. So we are going to see this demand carry on as well. And that's not even touching on the fact that we've still got demand from investors out there as well, which is very, very strong, which we're seeing here at Track Capital ourselves as well. So that's the summary, that's the headline figures. Now I'm going to move on to the more in-depth report and run through this. So firstly, obviously, we come with the first headline figure of house price growth, which was 6.1%. So the average house price has risen by 1.2% in the 3 months to the end of August. So that takes the annual rate of price growth to 6.1%, as we can see, which is up 2.8% from August 2020. Now, the average value of a property across the UK is sitting at £235,000. So we've seen over the past 6 months, Wales has the highest level of price growth at 9.8%. Northern Ireland is there as well, 8.4%. And then we see here the northwest of England at a strong 8%, which is again an region that we do focus on here at Track Capital at the moment for investment purposes for our clients. Price growth in Liverpool continues to be the strongest among the UK's major cities, and I mean, if you're one of our clients who's looking at Liverpool, that we've spoken about Liverpool with, this is something we've been keeping an eye on, and it's currently sitting at plus 9.8%, which is incredible, very, very strong. And Manchester is up there as well, and you've also got Sheffield there. Manchester at 8.1% and Sheffield 7.6%. So yeah, again, these are cities that we have been looking at for quite some time, and they are good cities that we recommend to clients who are looking for a specific type of investment. Capital growth being part of that, but also good yield and strong fundamentals for an investment case, which is something we are quite big on here at Track Capital. Now, in terms of house price growth in London, average values are up 2.2% on the year. So it is below inflation, but again, we're seeing positive signs there from the London property market, which is good to see. Then you've got strong buyer demand, which has been evident since May last year, with average home values rising by a greater margin in regions and towns where affordability is better. And this is something that we see with Liverpool. The affordability levels in Liverpool are very good, and there's actually still a lot of room for house prices to grow and affordability levels to be still very favourable. So again, this is one of the reasons why we are sort of anticipating Liverpool to be sort of a good long-term strategy for capital growth, with everything that's going on there. So the demand levels in London sort of did trail in parts over the last 18 months. And as we know, lack of international travel, people not being able to go into the offices. So people, especially sort of young working professionals, didn't need to be in London, so they could move back with parents or rent further out for slightly less and get a bit more space. And yeah, we are going to see that start to sort of turn around, as we are seeing it start to turn around now. Offices and international travel is opening back up. As you can see here, they're saying that the trend is starting to turn, with buyer demand up in the capital 14% over the last month. So very, very strong and good positive signs there. And as it says here, that actually translates into a 25% rise in demand for houses across London, and also a positive 6% rise in demand for flats. So very, very good. And again, you've got the chart here, which demonstrates the growth in house prices for August 2021. So next part of the report here. So this covers buyer demand up 35%. So really, really strong figures. And again, as I keep saying, one of the main driving factors behind the house price growth we're witnessing here in the UK. And this has been something that's been a consistent message for a number of months now, since last year, and it's continuing to be that message through the reports we're seeing, and I believe it will stay that way with further reports into the future. So, as we spoke about initially, there's been a limited impact of tapered stamp duty holiday ending. So you can see the chart here that demonstrates this. So the fall in both metrics of demand and sold subject to contract can be seen around March and April time. So this is when buyers would have had to agree a sale in order to have a chance of completing their purchase by the end of June and take advantage of the initial larger stamp duty savings of up to £15,000. So even though buyer demand started to decline slightly in quarter two, it still stayed high in comparison to historical figures, and albeit, as mentioned here, at sustainable levels. However, then when we look at late June, July, for the potential impact of the withdrawal of, as we say, the staggered or tapered stamp duty holiday at the end of September, there's little evidence of a change there. So because the savings were a lot smaller, obviously people weren't as fussed as making sort of the date or dropping off and saying, oh, I'm not going to make that, so I won't sort of buy at this moment in time. So buyers agreeing a sale in July, as stated here, are likely to benefit from around £2,500 savings from completions made by September 30th. And obviously, due to the time frame we're seeing sales go through, that's why we can see hardly sort of any changes there, and we can see sort of the run up. And very interesting to see that, actually, because as I mentioned, a lot of people were saying, oh, coming up September, a lot of people then are going to sort of pull out the market, etc., and that just really hasn't been the case. So now we move on to the how long it takes to sell a property. So here we're sitting at 27 days, which is incredible. So again, anybody saying that the market was going to slow down was very, very wrong. Properties are going on the market. Demand is very, very high. They don't last long. Open days are busy. I mean, you just have to speak to an estate agent and the message is the same across the board. They're all flat out busy. Properties go on. Interest is sky high. Viewing days are just jam packed. Bidding wars, and again, we're just seeing these inflated prices, and it's not slowing down because the demand isn't slowing down, and the stock just isn't there either to meet the demand. So since May this year, the average time taken for a sale to be agreed on a property when it was listed has been below 30 days, which is incredible. So the lack of stock has been a massive factor behind this. So as mentioned here, while the overall stock of housing available to buy is lower than typical levels, there are signs that some supply is coming from the market of landlords. So, hence it being the rental market here. So landlords are selling up, maybe cashing in these price rises. We are seeing a lot of sort of, so class them as old school landlords selling up. They've been in a long time. They see a good chance to exit and cash in. So we're seeing a few landlords do that. A few landlords not wanting to adapt with the change in the market, etc., and the rental market and legislation. Again, so selling up, a lot of tax changes, etc., has seen this for quite some time. So an interesting figure here, around 8% of properties listed for sale have been rented out in the last 3 years, which is up 3% from 2 years ago. So the proportion reaches 13% in London. So again, some landlords may be fed up with the rental market in London, but also, interestingly, which would be my sort of thought process, is some landlords are thinking, well, look, I can capitalise on the great prices in London that I've had for many years, and then I can reinvest it in sort of emerging markets or better performing markets, as we're seeing in your likes of Manchester, Liverpool, etc., etc. So, interesting here, demand from investors has certainly risen since the start of the pandemic. This, for me, is, I think people have seen bricks and mortar property as quite a secure investment in comparison to some others out there, especially over the long term, because stocks and shares can be quite volatile. You have crypto out there, which can be very lucrative, but again, very volatile, unpredictable, whereas in property, it's a little bit safer when comparing, especially we've seen the resilience of the property market in a scenario such as a global pandemic that we've had from the coronavirus, which I think has definitely shifted people's mindsets to property being a good solid investment. So that's very interesting to see. Next, the outlook that Home Track are stating is that the end of the staggered stamp duty holiday has had little impact on buyer demand, as we know, because the demand levels remain higher than usual for this time of year. The demand is predominantly coming from buyers searching for space, obviously looking to make the lifestyle changes where they've been cooped up, trapped in due to lockdowns, and they anticipate this to have sort of further to run. And again, I know they haven't mentioned it here, but we've seen a lot of investors come to the market as well, which I think is another driving factor behind the demand, especially in a lot of areas across the UK. So, as they mentioned, sort of a balancing part of this will be potentially the ending of government support for the economy, sort of via furlough, and the potential for more challenging economic conditions overall. So they believe this may have an impact on market sentiment as we move through to Q4. So it is going to be interesting to see how this plays out. I don't anticipate it having a massive effect, and because even if it takes out a slight sting of the market and demand, I don't think it's going to do enough damage when you look at the low levels of supply to really have a negative impact on the property market. So that's just my feeling anyway, and I think the property prices are going to continue to grow at these levels. You might see a slight cooling and sort of easing on the aggressive growth we're seeing, but I believe it's still going to carry on at good, healthy, positive levels. So what they're saying is that they expect the market to remain busy compared to historical norms, as I just mentioned, and for house price growth to remain firmly positive, again, as I just mentioned, in sort of figures at the end of the year, being sort of very, very sort of high, but they believe lower than the current levels of around 6.1%. And do I think that's the case? Potentially, but I don't think you're going to be far off the 6.1%. I don't think it'll drop below 5%. And again, I think you're going to see certain cities which will still perform very strongly, like Liverpool, example, because affordability levels and demand still being very strong there, which I think because of the other cities that are going to be performing sort of very well in terms of demand and low supply and house price growth, I think that's going to prop up the average UK house price growth figures. And that's why I don't think it's going to drop much below 6.1%, if at all. So they believe stock levels will start to rebuild in early 2022 as market activity returns to more normal levels. So that's their outlook, and that's my opinion on that. Now we look at some more interesting data and figures here. So this is a map here covering the regions and obviously Scotland as well. And this shows you sort of the house price growth by region. So we can see obviously Wales very strong. We've got Northern Ireland 8.4, Northwest very strong 8% there, but Southwest 7% very strong. Even the Southeast 5.4% is very, very strong. So all in the green, which I think is an excellent thing to see. Yorkshire and Humber 7.2%, and then East Midlands 7.4%. So these are excellent to see. Very, very positive. And as I continue to say, I believe it's going to stay in this green sort of colour for some time to come. Next, we look at this table here, which shows the UK major cities' house price growth. And Liverpool, as we know, number one there, so 9.7%. Manchester in second, 8.1%. Sheffield, 7.6%. Then we've got Belfast at 7.4%. Nottingham, 7.3%. Leicester and Leeds just behind there. And then you've still got sort of Birmingham here, 5.8% there. So for me, and I've spoke about this on previous reports, for me, the exciting and interesting figure when looking at Liverpool is this, and that's the average price. So the average price in Liverpool is sitting at 137,600. Let's take the 3 below, even the 4 below. Manchester 195, Sheffield 153, Belfast 151, Nottingham 175. They're a lot higher than Liverpool, and they're still growing very, very well. And we know one of the driving factors behind demand and the consistency in demand, one of them is the affordability levels. So we can see that the price here is quite a way off these ones. So there's a lot of room there, and with everything going on in Liverpool, we can see there's a lot of sort of legs that have room to run there, which is very interesting to see. So that's why, me personally, I think Liverpool's going to be really a great city to invest in when looking at it from a investment fundamentals point of view, but also in the long term in terms of capital growth, because we've got the affordability levels there. I'm very excited by that and see it very strong. And I think it's really great to see Manchester is still growing. You've got great average price being sort of quite high in comparison to Liverpool, but you're still getting a strong 8.1%. And that's because, again, the regeneration development going on in Manchester. As a city, it has a lot going on for it, and it's still attracting sort of buyers, renters, working professionals. Media City, as we know, has had a great impact on it as a city, and there's still regeneration and developments going on there. You've got a lot of sort of waterfront developments going on as well. There's just lots going on, lots of building. So again, there's going to be demand still heading towards Manchester. So I definitely don't see Manchester moving off any of these top spots anytime soon. Well, I hope that has been helpful for you. If you have any questions or want to discuss this report in any further detail, just feel free to reach out. You can email us at info@trackcapital.co.uk, and I'll be happy to discuss this further with you. I'm Toby, director here at Track Capital. I hope that's been helpful. Thanks for joining me, and take care. Bye-bye.